And good afternoon, ladies and gentlemen. Welcome to this, our 13th Industry Dialogue. It's great to see so many of you connected, and I would expect that in the coming minutes there will be more people even connecting to this dialogue. I think it shows that dialogue is crucial. Our dialogue with you on our joint work is crucial. We do it in multiple formats. We have this dialogue ongoing between you and the internal resolution teams. We have it through direct engagement in various events, including these dialogues, but also our big annual conference. And those of you that are following us for a number of years have, I hope, realized that we've changed the format of this industry dialogue a bit, and I will explain in a moment why. I think we are just striving, and this I think is what we really do, to improve, enhance further our communication with you. And therefore, my communications team actually asked me to thank all of you that took part in the recent survey, which they are currently looking into to enhance also our communication methods. I'm looking forward to get the insight and to see the further improvement here. Today, we want to go a little bit, or definitely a bit, beyond just informing you and using our time with you to stipulate a discussion and hear your thoughts and ideas. To be fair, after our last industry dialogue, we had an internal discussion because the way I framed it was, we call it industry dialogue, but there was little dialogue. We informed and no questions left. So I hope that the new format will work further, will enhance the dialogue and not just the information. And I'm very much looking forward to the two panels that they are coming up today, the one on separability and the other one on bail-in execution. And I would like to thank all panelists for their participation, but knowing that the beginning of the year is always a very busy period for CEOs and CFOs, my special thanks go to Mr. Diaz Garcia, Mr. Gross, Mr. Del Punta, and Mr. L'Official, sorry for pronunciation problems, for having made themselves available this afternoon for this discussion. And for all of you dialing in, there will be time to ask questions and give us also your views. So please don't hesitate to get involved and make use of the insight of our panelists. After our panel discussion, Sebastiano will also give us a very brief update on the latest MREL dashboard, which you could find on our website, and the 2022 MREL policy, so what to expect, and take your questions if you may have the one or the other. Before I hand over to our moderator of today, Michael Vincent, I would just like to take a little step back and report on what is going on, respectively what we have achieved together in the last months. The pandemic has now dominated our lives for 2 long years, and you see that this format is still a remote format, online. I would hope that the next industry dialogue can be again a dialogue in person with an add-on of remote participation, but to see more people than to sit here together with our technicians very lonely in a big room. So I would hope this is going forward. But however, we have to say that the financial industry, the banking industry, and the authorities were able to deal very effectively with the challenges posed by COVID, and we have seen progress on a number of fronts. Just to mention one, which is not immediately affecting all of you, but is very close to our heart. Last year, the Council decided on the early introduction of the backstop to the Single Resolution Fund. It's still not done because it's embedded in the treaty changes for the ESM, but we are hopeful that we will get it very soon, because I think we all agree market confidence in a time of crisis is key for effective bank resolution. Though I hope we will never touch it, we need to be sure that we are having this kind of backstop, last resort available, and therefore we are grateful that this is hopefully coming in the coming weeks. At the same time, it does not cancel the need for really effective resolution planning and crisis management, and this is what we are here for. We need to continue to build on our progress and make our financial system stronger and more stable. And before I briefly touch on our priorities, let me also take one step forward to, I would call it, more transparency in assessing resolvability. We have designed, and most of you have heard this before, a so-called heat map to monitor, benchmark, and ultimately also communicate your progress towards resolvability. Achieving a consistent, realistic assessment is by no means an easy task, but it's a very valuable exercise. And we will be, as we have been, clear in our communication to all of you, and in particular to those that might be lagging behind their peers and have still to get their house in order. The expectations for banks that we published in 2020 were clearly setting out the roadmap for resolvability, and 2023 and 23 remains the deadline for all banks to become compliant with their MREL targets, except a few that have a bit longer deadline, and having reached resolvability in line with the expectations for banks. We expect to provide more transparency as a result of this first heat map exercise, and then on an annual basis later this year, once the results have become sufficiently stable, or as I put it in Parliament, once we have come out of 1,000 shades of amber. Despite the pandemic, I'm glad to note that the industry has so far stayed on track to deliver on our expectations and has continued to build up MREL. Sebastiano will come to this at the end. And I hope this will remain the case as countries emerge from the pandemic and transition away from providing large-scale support to businesses. For me, there are three main areas and priorities for us and for you this year, and you could easily find them in our work program for 2022. The first and foremost, like in the past, is MREL build-up. Has to continue to be a key priority for 22 and beyond, and has been positive to see that most of the banks were able to respect their binding 2022 intermediate targets. I can just urge you to continue this work as the final target approaches in 24. It's just less than 2 years around the corner, and you never know whether the sun is shining tomorrow too. Second is the area which we will come on later today of separability and business reorganization plans, which will be discussed in more detail today in the first panel. As Sebastiano will explain shortly, we are prioritizing the work on transfer tools, so sale of business or tools in basically and separability in 2022, and there's very good reason for that, because if you don't need it for the resolution strategy, you might need it afterwards for reorganization. Nothing is for granted here. And there is our third topic are information systems. The pandemic has once again highlighted the importance of efficient and reliable information systems to ensure continuity of operations during crisis times. Availability of correct data in a timely manner is one of the key priorities for resolution planning and crisis preparedness. Let's hope we stick to crisis preparedness, because in case of a resolution, this information is key to make the difference between pass and break. Please don't wonder when I'm just mentioning those three, and I have not mentioned the topic of our second panel, bail-in execution, because for me, this has been a topic, this will be a topic. This is one that has been, is, and will stay with us as a key priority to make banks for banks to be resolvable and to be prepared for the worst that hopefully will never ever happen. With that, I would come to a close. I'm really looking forward to the discussion this afternoon and to our continued cooperation with you. Let me stress once more that our dialogue with you is an essential part of our shared work on resolvability. I think when we go back some time, you will see that we had used it in 1 year, even as the title of our annual conference. Thank you for all your engagement. Thank you for your commitment. And I am now really looking forward to an inspiring discussion, hopefully giving good benefit and good insight for all of us. As I said, let's hope that this is an industry dialogue and not a monologue. And with that, I will stop and I will hand over to Michael Vincent, who will be the moderator of the panels. And I'm pretty sure, Michael, you've made your housekeeping remarks beforehand, but it might be good now that more people are on board that you start with the housekeeping remarks once more. Thank you. And I'm now going into listen mode and hopefully get many new ideas.
Thank you very much. This was Elke Koenig for the opening remarks. And indeed, you give me a great transition to remind people that this session is being recorded. To make sure it happens smoothly, we recommend people to stay on mute as much as possible. If people don't want to be recorded, we encourage you to turn off the camera and the microphone, and to make extensive use of the chat and Q&A functions to be able to share your remarks or questions to our panelists. And to the extent possible, I'll do my best to pick some of the questions and let also the panelists know if they want to address some of the points being made in the audience. As Elke has emphasized, this is very much a dialogue from the industry, so we are very much here to hear from you. And without further ado, I will open the first session of the first panel discussion, the one on separability, for which I would like to warmly welcome and thanks Paula Conte, the chair of the FROB in Spain, Xavier L'Official, the CFO of Société Générale, and Jacobo Diaz Garcia, the CFO of Bankinter. Last but not least, and for the opening remarks of this session, we have Sebastiano Laviola, a member of the board of the SRB and the director for the Resolution Policy and Cooperation Directorate. Sebastiano, thank you. The floor is yours.
Thank you, Michel, and good afternoon, ladies and gentlemen, to everybody. So, as the chair has just remarked, this first panel touches upon separability. What is separability? What type of policy is it? Well, the concept, I have to say, enshrines all the transfer tools at our disposal, including selling the business, setting up a bridge institution, or coupled with any other resolution tool, using an asset separation company to deal with impaired assets. Separability, as in our policy, can therefore be defined as the bank's ability to implement a transfer of legal entities, business lines, or portfolio of assets and liabilities at short notice to a third party. It allows the SRB to execute, together with the national resolution authorities, a market transaction within a reasonable amount of time. This is in order to assure the resolution objectives through the bank's transfer to a private owner, or ultimately through an orderly wind down. But as Elke has just mentioned, separability is a relevant concept beyond also transfer strategy, because it is particularly important for this transfer tool as preferred resolution strategy, but it is also applicable to bail-in strategies in a restructuring phase post-resolution, or where the variant strategy combines the bail-in tool to an asset transfer tool, to ensure that the different arms, the different parts of a banking group can be separated in an orderly manner that is without disruption of critical functions and core business line. To provide you with some statistics, in 21 cycle, out of 110 resolution plans, the overwhelming majority being plans earmarked for resolution, 16% of them had the transfer tool as the main resolution strategy, 35% had it as variant strategy. Transfer strategies are often suited, as we normally say, for mid-size and small banks that rely mostly on equity and deposits for their funding. In those cases, a sale transaction could be more credible and less costly. But they can also be part of the plan for larger banks, especially as a variant strategy or as part of a business organization after resolution. But of course, we know that this needs excellent and timely preparation and, of course, a willing buyer. It is in this context that the SRB prioritized separability on three main areas. First of all, the policy. The MREL calibration is being reviewed and targeted for transfer strategies. The resolution planning. As many of you probably know, the SRB provided a public guidance on separability for transfer tools in October 21 and prioritized it, as the chair said, for this calendar year, for 22, for all banks having a transfer tool either as preferred or variant strategy. The guidance set up the minimum requirements on separability analysis reports and transfer playbooks. It is applied with the necessary proportionality and a different phase-in when a transfer tool is envisaged as preferred or variant strategy. Third element, crisis management. We have launched an operational project, resolution tools other than bail-in, which my colleague Pedro is among the drivers, to increase the crisis readiness for the use of transfer tools. The SRB has been working last year on operational implementation manuals for executing the transfer tools. The work performed includes the development of a set of supporting tools and templates that follow market standards and best practices. The operationalization has been designed in the context of a single resolution process aimed at delivering the most effective resolution transaction that is achievable on the resolution weekend. Flexibility, as always when we speak of resolution strategies, is needed to adopt certain tools according to the characteristics of a particular crisis case, and in order to react swiftly to new information as it becomes available, be it investor feedback, changing market condition, increased liquidity outflows from the failing bank. So separability, in addition, fits, as the chair mentioned, also our assessment of banks' resolvability. We have developed the resolvability assessment heat map, implemented for the first time in 21 resolution planning cycle. This will capture the bank's progress and allow benchmarking against the 22 priorities, including, of course, on separability. In this overall context, for this panel, it will be interesting to hear the perspective of two banks of different size and complexity, as well as different business models, Mr. Garcia from Bankinter and Mr. L'Official from Société Générale. They will provide, I believe, their experience on the implementation of a transfer tool underlying the separability strategy, the associated benefits and challenges of separability planning, as well as, we hope, their view about some of the key expectations in our guidance, notably how to identify the perimeter, take into account or mitigate the interconnections, assess the marketability. On the regulatory side, it is a pleasure for me and for all of us to have in this panel Paola Conte from FROB, who will share with us her experience on the role of national authorities, in particular on how they can best support the work of entities in preparing and executing the separability process. Without losing any further time, I look forward to this discussion, and the floor is yours. Back to you, Michael. Thank you.
Thank you very much, Sebastiano, for those opening remarks. I'm tempted to deep dive straight into the industry's opinion by looking at Xavier L'Official. As it's been expressed just right now, The separability guidance foresees some expectations for the separability assessment. We just heard some numbers that it applies to a variety of cases, type of banks, preferred resolution strategies. And for a bank, a banking group so large like Société Générale, how is the approach to the question of separability, taking into account indeed this size and complexity, and for which would be interested to compare with the vision of your colleague from Bankinter, Jacobo Diaz Garcia, which is the CFO of a bank of a different size and type, and for which the question might not be tackled the same way.
Okay, thank you for your question and good afternoon to everybody. I hope you can hear me well. So to start with, and as it was mentioned, like for most of the GSIB, our preferred resolution strategy is open bailing tool. And we do believe that it's the right one. Nevertheless, as you mentioned, separability can be an asset, can be a tool that can be used, and we want to definitively continue to work on that. What we understand from the guidance for banks with bailing as a preferred resolution strategy is that separability might be envisaged either part of the preferred resolution strategy. As an example, and I can elaborate on that, on the usage of asset separation tool to transfer some NPL, and I would like to develop on this example. Or, if I may say, as a variant of a variant resolution strategy, when the variant strategy is the sale of the business of a whole group. If I come back to the first point of the usage of asset separation tool for NPL, this seems rather clear to us. Even if, and we can discuss on this point, identifying in advance the perimeter of a future sale of a future portfolio of bad loans that is significant enough to play a role in our resolution strategy is challenging in a group diversified like ours. In fact, the size of our bad loan portfolio must be significant enough to threaten the bank, and is currently, if it is in a way significant enough to put at risk the bank, we would act on it, and we would have already worked on reducing the risk. So if you see one of the dilemma we would have in our, or one of the questions we'll have to answer in our context is one, anticipation, but secondly, an anticipation on something that we did not anticipate previously, as we are already carrying this risk on our balance sheet. So we have started on this aspect to work with our IRT last year, notably through the definition of a severe capital scenario. However, again, the underlying macroeconomics assumption for the severe scenario goes in a way well beyond our recent history, and the capacity to have a precise estimation and anticipation of the epidemic becomes extremely difficult. So we have decided to take another approach and to address this topic is really to focus on our largest portfolio, for which we do have already an existing or an experience of selling NPL portfolio or processes where already we have a capacity to prepare the data. You mentioned in your introduction the importance of getting the right data, and we are in a way refocusing our approach, not, I would say, on a very theoretical approach, relying on macro scenario that we have difficult to assess, but really on our risk profile, on our current portfolio in order to prepare it. If I come to now separability as a variant strategy, this is for a bank like ours, and it's not only a question of complexity, it's also a question of diversity of our businesses, diversity of our geography, another difficulty, which is the number of available options, of the number of routes we can take for this. And these routes will again depend on what had happened before a resolution. We do consider that some scenario might, let's touch wood, or will never, but we need to get prepared to that, bring us to resolution, but we all consider that things will have happened before, and all these options will actually will be taken into account in our recovery and resolution strategy. So depending on the magnitude of the loans, where they would occur, what option will be executed from the recovery plan. As an example, some business, yes, could either be transferred, some business could either be sized down, wind down, or liquidated. It's very worth mentioning that the size down of a business, in our opinion, might be less costly and more rapid than transferring it to another player, whatever our level of preparation would be. So now, given the fact that separability in the context of a sale of business variant resolution strategy is a variant of a variant, and given the fact that there's still a lot of to do in our preferred resolution strategy, we would encourage really the authorities to be really pragmatic on the topic and to allocate the right time on this approach compared to our preferred resolution strategy.
Thank you, Xavier. To get maybe a view from a different business, different size and different resolution strategy, I will look at Jacobo Diaz. Maybe if you could bring us your perspective on this, also to the extent that for some of the Spanish bank, the topic of separability has been also prior introduced. So how much also maybe of this anticipation helped in achieving the expectation now that they are published or that they have been published in 2021, for instance?
Hi, hello. Thank you very much, and thank you for inviting Bankinter to this special session. First of all, of course, we are quite different from the previous speaker. I mean, we are a domestic bank. We are focused around 90% of our business in Spain, although we do have operations in Portugal, Luxembourg, and Ireland. And our business model is different. We are much more integrated across our branches and special business centers. We are a very efficient bank with a very good profitability and very low credit risk profile. So it's a very different approach. Of course, regarding anticipation for us has been critical. It's been very relevant. It has given us a lot of time to talk quite a lot with our IRT team. And of course, this has been probably the largest debates we had were related to our separability approach and of course the perimeter. As you can imagine, in a business like us, I mean, we are around 5 billion euros of market capitalization and around 100 billion of balance sheet size. So this is something, resolution is not a topic that we used to talk in the past. Of course, this has been a new topic for us, and it has taken a little bit to come on board on this relationship. I must say that the relationship with our IRT team has been splendid. I mean, they've been very supportive, although also very demanding. But at the same time, it's very transparent and very open. And I think our first main challenge during this period, this anticipated period, was to try to explain how was our business model, because I think that was the key to really understand later on, or to go into debates about the critical economic functions or the core business lines and how to tackle which should be the right parameters. Of course, we need to be aligned with the resolution objectives and try to find out which is the minimum perimeter that should be the most appropriate. But I think we've done plenty of work trying to find out the good equilibrium between which is the minimum perimeter versus which is the real attractiveness of the business for a potential resolution, a potential buyer. Of course, trying to explain simplicity of our business versus the interdependencies that we have in our business. We do not have many subsidiaries, and whenever we have a subsidiary, it's 100% fully owned by us. So from a legal perspective, our approach was not very complex. Although the most complexities had come from the interdependencies in terms of financial relationship with those subsidiaries and from an operational relationship with these subsidiaries. As the first panelist mentioned, management information system has been key in the debate and in how to tackle these separability expectations. because all the different businesses need to have a proper financial information that provides a good insight about how valuable is that business and which are the pieces that might be considered within and which pieces might not be considered within. Just bear in mind that obviously previous to resolution, there's been a recovery period. So that recovery has also come to certain type of decisions. So at the end of the day, in a bank like us, we went in a process to finish up with around 4 perimeters that were offered, 2 main options, and all this has been thanks to the ERT team that has guided us in the process, have been very demanding in the topics that where should be a set of the minimum parameter, and from our side, try to convince them about the attractiveness of some complete type of business. And overall, it's been very, very important to have anticipated, at least for the Spanish bank, to have anticipated this guidance.
Thank you very much. I would like also to quiz our colleagues from FROB and also go back to Sebastiano to get the institutional touch. But before doing so, because it's been mentioned in what Xavier and Jacobo just said, in practice, and that's for both of you, how would you assess this trade-off indeed between achieving the resolution objective and the continuity of critical function versus the attractiveness of the core package, its marketability, given the current and also the worst possible forward environment in the context of resolution? That's a typical aspect to which I would like to hear your views from.
I can jump in if you don't mind. As I mentioned, Bankinter's business model is quite simpler and maybe unique. So first, the key is to understand the feasibility of any strategy. For us, the preferred strategy, of course, is a share deal or an asset deal. For us, with the 5 billion of capitalization, a share deal is probably easier. But of course, we need to be open to an asset deal, and this is something that need to be addressed with a lot of effort, because there is a correlation between the number of dependencies with the complexity of the process. So the largest number of independencies is the more complex. So at the end of the day, we need to develop a capability to anticipate that resolution process. We need to put in place, or we need to define some strategies thinking about an asset deal, which is probably the most complex in our case. So we need to think about which type of securitizations we will put in place, what type of portfolios we could sell, what kind of endorsements we will need. Everything is just trying to make sure that there is a good equilibrium or a good approach to this asset deal. You were mentioning about the attractiveness. Of course, for us, at least in our case, Bankinter is a bank that was born as an industrial bank, and we have born organically over 50 years. So everything is linked with it within our organization. For us, the critical economic functions is a sort of a quite minimum perimeter that also provides a minimum value. So for us, it's very important to be able to convince that in order to gain the largest figure of attractiveness, we need to take all the business as much together as we can. We need to understand which are the minimum from a resolution of perspective, but we need to make sure that the attractiveness of the business is real. It doesn't really make sense to have a really small perimeter that nobody wants to buy or nobody could be interested in. So we need to make sure that we have a very good picture about it.
Thank you. Xavier, if you want to complement.
Yeah, we'll complement, but very shortly, because as I mentioned earlier on, this approach on the concept of core package is not at the heart yet of our resolution strategy. So it's in a way a variant of a variant, and we started to work on that, and it will surely be more important or a higher priority in 2023. However, from a conceptual point of view, the concept of core package for us it's very difficult in a way to assess. due to our geography, due to our complexity, due to the fact that we have fixed cost, viability, profitability that might be really different on a standalone basis versus a combined approach with another bank. And the perimeter of interest of an acquirer, if we come back to the attractiveness of the topic, will really be different from each acquirer. It will depend on its current business model. So having engaged with M&A action in the past year, either on the buy side or on the sell side, this is something that we regularly observe with different carve-outs depending on the buyer's appetite. So I don't have a straight answer. I'm just putting on the table a natural complexity that we have to deal with in Société Générale with this topic. But if I may, Michael, before giving you back the mic, one of the ideas that we would like to maybe hear and to consider is the notion of a kind of partial sale of business share deal that could be a complement to the billing with the objective in a way of maintaining a core bank in the market, not to sell or to dismantle it totally. And I would be happy to hear if it is something that you, from your perspective, would be ready to discuss with the industry, or if you are already considering this approach. I'm just trying to reverse a bit this object with a new idea that I did not understand, like being in the guidance.
I'm very fine with being answer questions with questions because I'm not going to be the one answering them. I'm turning to Paola and Sebastiano whether they want to take it or if they would rather take it offline.
Oh, I mean, I don't know, Paola, you want to go first? I mean, as you like.
Well, thank you. Well, first of all, good afternoon to everyone, and thank you very much for the invitation to participate. And actually, I think this is actually one of the things that I was going to mention today, that the best way that resolution authorities can support banks is by providing effective guidance and expectations and on what has to be done, but in the same time, also maintaining a permanent dialogue with those banks and receiving feedback. And I think that's actually one of the objectives of setting separability as a working priority for 2022, and because I'm sure it's going to be the main focus of many IRT workshops during this cycle. And I think the SRB is definitely doing its part as SRB in the sense of the IRTs, of course, including the national resolution authorities. We're doing our part in trying to provide that guidance. And I think as well, it's also important today to highlight here in front of all the banks of under the SRB remit that actually we've gotten here in a learning by doing process. And actually that the guidance that we're providing is very much based on the work that was already done by the first banks that have been working on resolvability. And I think it's important to recognize and commend that. And I think it's also very illustrative of the fact that indeed that dialogue continues. And I'm sure that that part of that dialogue is definitely taken into account the different situations of different banks and how this can be addressed. And certainly I think the work on separability is definitely crucial for sale of business tool. And I think in that regard, guaranteeing the feasibility and credibility of that strategy, it's indispensable, but also very important in bail-in, precisely to have an array of options to choose from when the failure of an institution takes place. Because I think it's definitely promising to continue to discuss the different options, and I think that's definitely the stance that has been taken until now in the IRTs, and I'm sure that Sebastiano will have more to say on the specific SRB position.
Thank you. Thank you. Well, I think thank you for the two speakers from the industry for giving us useful insights and different perspectives regarding a small bank, small, medium-sized bank with respect to a complex, diversified bank. I believe that, it is clear here from what it emerged that it is very important to have a lot of preparatory planning to achieve separability. And this is particularly relevant as we put emphasis on the policy, but as confirmed by the Spanish representative of the bank, but also from the point of view of a large complex bank, if the main strategy, as declared, the open bank bail-in is not, for a reason or another, is not the best way forward, or cannot be enforced until the end, etc., etc. So there can be various issues. And I understand also for Mr. L'Official from Xavier that he's saying we are working, first of all, in terms of identification of a portfolio like the one on NPL, but the work would first start on recovery, and preparatory planning here is key. But as separability as a variant strategy here is more difficult, and we would in any case start from the recovery plan. Your question, to come to your question, I don't shy away from the question, is that this is what you are proposing, if I understand correctly, is why we could not consider together with bail-in, so not as a variant, but together with bail-in, a partial sale of business, so to complement bail-in. Well, let me first say that in my introduction, I said that the separability policy is, of course, important in the context also of bail-in strategy as main strategy when you are post-resolution in the business restructuring plan, because clearly if you have to divest certain activities as liabilities, you have to proceed towards a kind of separation. So the preparation ex ante is in any case important. I think the step you are proposing is instead something else. That's to say, to consider these two tools. One is a transfer tool and the bail-in together. Well, I do not have I would say a position at the moment, but I would like first to see progress respectively in the different strategies and different tools, and then to discuss case by case what are the best options possible. Thank you.
Thank you, Sebastiano, and I hope it does tackle some of the questions of Xavier L'Official. Since we are on the topic of strategy and variant strategy, I think maybe back to a more maybe Spanish specificity is that for banks of that type, the bridge bank tool is often selected as a variant strategy, and it would be interesting to hear from also from Bankinter, but also from FROB perspective about the impact on the separability assessment, but also maybe more from FROB perspective, the challenges when it comes to create such a bridge institution in this context.
Okay, I'll go for this question. Yes, as you've mentioned, the bridge bank is our variant strategy in case of we do not reach a potential share deal or asset deal. Of course, this variant strategy means that this is an unexpected scenario, because I think that all the value and all the effort needs to be put on the preferred strategy. So as you can imagine, in our case, at least in our case, the bridge bank is a scenario which is much more complex and a little bit more riskier in terms of a successful transaction. Just bear in mind that this means that there is a temporary sort of banking license, that this is a short period of time where you need to build a complex element, which is the bridge bank, but it must, their objective is to be in a short period of time, and that period of time needs to keep working as with business as usual, when you need to build up everything around it, all the liquidity needs and operational needs. So that means that there is a lot of effort in terms of defining and anticipating how this bridge bank will work. In our opinion, and if an asset deal or share deal hasn't really worked, the bridge bank brings some risk into the table, at least for the business, or at least in a business model like ours. From a value perspective, that means that neither a share deal has been able to be achieved and neither an asset deal has been able to achieve. That means that from a value perspective, there is a very quite high potential that the value of this bank goes down. That means that there is much power of negotiation from a potential buyer than it used to be in the previous steps. From a management perspective, it's also much more complex, because that means that the bank has problems to being sold, or at least being sold in different assets. And that means that probably from the clients might be a little bit more reluctant to work with the bank, or even to withdraw deposits. And the last one potential risk that we see could be even reputational, because when you haven't been successful in the prior preferred strategy, from a reputational point of view, the execution and the establishment of this bridge bank might not be very well perceived by the investment community or by the clients. So in summary, I mean, the bridge bank is a complex tool that needs to be very, very well defined. It's very complex from an operational, from legal, and from a financial perspective for a short period of time, or at least for an expected short period of time. Having said that, I mean, everything must be prepared, but in our case, at least in our case, we hope that this variant strategy might not be accomplished.
Thank you. So we hear from you that there's some concerns about the potential signal it would send to the market. Paola, I'm turning to you maybe to hear about more on the challenges, operational challenges of the setup of such entity.
Yeah, well, just a bit to go a bit further into what Jacobo was saying. I think indeed the bridge institution is actually the variant strategy. So the preferred resolution tool is the sale of business tool, and the sale of business tool has proven itself to be a successful tool, already tested in the banking union, and it obviously has many advantages and would be the best tool in meeting resolution objectives by allowing critical functions to continue, minimizing the impact on financial stability, thanks to a buyer who provides the liquidity, the solvency, guarantees access to market infrastructures, and restores confidence in the markets. Of course, the sale of business tool relies critically on two conditions. One is the time to prepare the process and for that to take place, and the other is obviously finding a buyer. And this is where the bridge institution tool, which, as Jacobo was saying, has other operational challenges, is, I think, the fallback option. And the superability assessment work is actually very useful in that regard, because it is meant to obviously enforce the feasibility and credibility of the sale of business tool. But in case of the lack of a buyer, then it is also the useful work that works for a bridge institution. And in that regard, I think that's why it's important to stress precisely today, that the importance of the superability assessment in actually reinforcing the feasibility and credibility of the sale of business tool. Because on the one hand, all the work that banks are doing, and the Bankinter and other banks have done in creating a searchable repository that it identifies the information that has to be provided, that already sort of has created a VDR that will be accessed immediately in case of a crisis, is already a huge step in terms of guaranteeing that a sale of business will actually be feasible. And as well, being able to detect obstacles and remove them ahead of time is also work that is very important in that regard. And finally, I think I've also heard a lot about from the banks on the analysis of different perimeters and how that's also a challenge. But I think it's very useful work, because it as resolution authorities, it provides us with flexibility at the time of a crisis to actually be able to maybe even design packages or a package or packages for a buyer or buyers that is most attractive at that point in time, and in terms of the market appetite that has been tested before, etc. So I think that precisely a bit of the operational challenges that the bridge institution tool faces reinforce the need for the superability assessment to actually substantial progress to be made, because it is what guarantees the feasibility and credibility of the sale business tool. And in terms of the challenges, I think many of them actually fall on our side as well, in terms of being able to obtain a license in time, and other transactions and other operations that are important. And in that regard, I think national resolution authorities were also doing our part in preparing the so-called national handbooks and also operational steps documents, which in a way mirror the playbooks that are prepared by banks, and they go step by step to looking at what authorities are involved at each stage, what would be required, who would be doing that, and that is something we are looking at right now, identifying indeed certain obstacles. That's also it's challenging in to the extent that it involves many authorities, not only the resolution authority, and that's something that also national resolution authorities work on in order to, as I was saying, make this joint effort in terms of separability and the successful execution of transfer strategies in the future.
I'm looking at Sebastiano, maybe if you want to complement also on the aspect of separability, building on the effort of both entities and authority, and how this relationship helps improving the overall resolvability.
Sorry, I was on mute. Well, I think that it has already been stressed both by the bank's representatives and by Paola that this is a common effort, and we have to work, in order to arrive to a situation where, we conclude positively on resolvability of the institutions from all sides, that authorities and intermediaries have to work together. And in our guidance, this is clearly mentioned, because the resolution experts will guide also step by step on the various tools on what is requested and what will be assessed. Now, as to the credibility and feasibility of the strategy, I believe that, as it has been already stressed, the planning in anticipation, so early planning for that is crucial. So in other words, if you want to go towards a transfer pool, early preparation for that is key, is of the essence. In particular, as concerns the market capacity and investors' interest, so to have the capability to identify potential buyers which are interested in the identified perimeters in terms of geographical footprint, in terms of businesses that they would be interested, in terms of appetite for further transactions and M&As, and in terms of all that we have said, maximum clear transparency and clarity regarding the interconnections, regarding the legacy, what goes out, what remains, and what are all the interconnections that have to be either removed, mitigated, or considered, that's to say, added in the perimeter, in the separability analysis, and therefore be part of the transaction. So if this work is done, I think that this would increase a lot the credibility and the feasibility, because we know that the directive, the BRD, already includes a number of articles regarding what can be done and cannot be done in terms of transferring various assets and liabilities. But then there are other types of assets and liabilities which are not mentioned in the directive. Therefore, they are not legislative safeguards, but they can be operational, legal, and financial linkages that have to be assessed. And if that's the case, they have to be, of course, unwound. So this can be, complex arrangements, particularly in bigger institutions regarding fund trading, hedging operation, management of the risks, and so on and so forth. I would conclude by saying that with respect to what I have heard regarding the bridge tool, the bridge tool as a as a possible tool, certainly it is the most complex, if you want, and the ones that it is more intertwined also with a number of, let's say, specific national regulations and procedures. And therefore, it is of the utmost important, as Paola said, that also national authorities, which are in charge immediately after the SRB, to execute, essentially, after the decision has been taken by the SRB, if ever it happens, to execute the resolution strategy. It is very important to be aware, if this tool were to be used, of all the complexities and national specificities that have to be addressed. Then there is a work to be done with the banking supervisors, because of course it is supposed that there is a bridge bank, which can be normally in public hands for a temporary period, which has to receive a license and which is supposed to be operational. And therefore, I mean, we are, of course, working and discussing also with our colleagues regarding that. However, I would, although, I mean, this is, of course, more difficult, I would not disregard it as a tool to be considered among the number of tools available. And we have had, you know, in certain countries outside of the banking union, there is a certain experience regarding resolving bank and always having essentially a bridge institution, so that the assets and liability are transferred except the losses, and then they are sold all together or in parts, I mean, then over time. Now, not necessarily this means winding down and losing value. It depends. It depends on how it is done. It depends on the market conditions. Thank you.
Thank you, Sebastiano. I'm tempted to look back at Xavier L'Official, also that mentioned the list of a tool that can also complement each other, also a reference to bail-in plus sale of business, partial sale of business. Last year, the SRB has introduced for the first time its solvent wind down of trading books guidance that helps separability for banks with large market activities, with the idea to complement the various tools that's been mentioned already, the idea that for large trading activities, better understand the interconnection, and also for the bank to demonstrate the capacity at the end of the day to wind down their activity by themselves. And since for the time being, this new guidance applies to GSIBs, I would be very keen to hear from Xavier how this has been received and how it fits into the overall separability analysis as far as SocGen is concerned.
Definitively, it's a very good, powerful, and important tool to us. I mean, if you look at the resolution plan of large US banks, and which are public information, we can see that all of them do consider solvent wind down for their market activity. And here I do believe that it's a global market with solutions that definitively should be or could be similar. So very well appreciative of this approach, and we do consider that solvent wind down preparation is at the top of our agenda compared to separability of market activity. We have to weigh and to prioritize that. So on the other hand, even if some portfolio could be sold or novated, again, everything is contextual, and the precise identification of this portfolio is sometimes difficult in advance. It will depend on their attractivity, on their size, and this is changing over time. So our approach to preparation to that is, one, to base it on the experience we have had on portfolio transfers. As an example, with the acquisition 2 years back, if I'm correct, of some activity of Commerzbank. Experience that we also had on wind down with a commodity desk that we wind down roughly at the same time 2 or 3 years ago, or going back more to the past, to a transfer and then wind down of our legacy asset portfolio during the 2008 crisis. So again, very aligned with the strategy of the bank. We consider that this is a very good tool, and we will continue to get prepared and to prepare it. My main message being that a bank like ours, thanks to acquisition, to sell, to widen, we do have experience, and we do want these processes to be as close as possible to what we do in quote unquote production, because it's the best way to make sure that it does function.
Thank you. I'll make sure this is conveyed to the person responsible for this. I'd like to remind also the participants that they are very welcome to ask questions via the Q&A box that you can see on your right. Maybe the opportunity to add on top of the dimensions that have been discussed, unless someone would like to take the floor to add on what's been said. But I was also curious maybe to quiz you on how the work on separability helps also from a business as usual perspective. I understand there's been some discussion on the difficulties to forecast what would be the NPL parameters, what could be the parameters of the portfolio in the context of solvent wind down. But those tools, to a wider extent, can be seen as a continuum between BAU, recovery, and resolution. And even though the circumstances in resolution would be maybe more tricky or a bit different, those tools could also support overall the housekeeping in BAU. And I was curious to hear if indeed there's some values also for BAU that you've noticed from all those guidance and expectations.
I may start, and the answer is yes. Yes, it does, because as I was trying to illustrate, basically our approach to this topic is to be as close as possible to production, and coming back to the ability of the data, access to the right data, we do sell NPL just to reduce our risk because it's our business strategy, or we get prepared to a resolution approach. Basically, in terms of quote unquote infrastructure, for us, it has to be the same because this is what is going to make sure that should this event happen, we are ready because we know to do it, and not only through dry runs. You know that dry runs are tedious exercise that do cost a lot of money for us. Let's be clear on that. And getting it as close as possible to our real production, and not only crisis. Selling an NPL portfolio is not a crisis, just deleveraging. It's normal. As close as possible to our production approach is really, in my opinion, a win-win deal. So this is why we have a strong dialogue, a very important dialogue with our IRT, with exactly the objective that you did put on the table, which is how can we leverage on our production to get resolution in a better shape, simply because it will be processes that have been tested in Société Générale as an example, and also that resolution needs to understand the impact of the impact that it has on production, so that it's a good balance.
I may jump in now. Yes, I think it's been very useful for the BAU. Of course, it's as I did mention, a lot of work, and very demanding aspect. However, I think that as a bank, we've made huge progress. For example, in data, I think in management information system now are much more stronger than they used to be before. We have plenty of granular information which are now stored in our data warehouse or in our big data, and that's huge because you can use them for different purposes, excluding resolution. I mean, commercial activity is a good example. I think the second benefit of it's been to have a clear picture of what you are. In terms of the legal structure, for example, the structure of your subsidiaries, which are the financial interdependency between those subsidiaries, and maybe you have found out that maybe I should change the way that our relationship works. We've noticed, for example, when analyzing the operational interdependencies, that they could be very difficult of different options in terms of separability, but you might be able to put in place different structures that make our life easier in case of these things happen. And sometimes you may figure out that trying to be simpler may also be a good task to be more efficient. So yes, I think I strongly believe that we've been benefiting from a different point of view about this resolution aspect. Of course, when you think about coming back to the debate about the perimeter, you think from a business perspective, and you realize that I need branches, but I need also contact centers. But of course, I need the asset under management business. So everything is like very, very linked, and everything is very, very integrated. And you realize how many synergies you have. So I think it has been a good benefit for us to go through this exercise. Although once again, we need to admit that I mean it's quite tough. So.
Thank you. Understood. Maybe before closing, Paola, if you want to take the opportunity to say a word on dry runs, possibly, or is that something that could be considered where the institution could see value in it, even if we understand that the cost can be substantial?
Yes, actually, I smile because for national resolution authorities, it also has its own cost as well.
Of course.
But I do think having lived through one of the experiences in the banking union, I do think the importance of crisis simulation cannot be underestimated, and it's very important to test the manuals. Obviously, and there has to be a lot of exercises, because another thing to learn, though, is that each exercise focuses on one specific aspect, and it's impossible to try to do everything all at once. But I would stress, and I think if it's any consolation, just to know that on the authority side, dry runs and crisis simulation are also a large part of our focus and part of what we will be doing. And I'm also very heartened to hear Jacobo say that some of the work that they have to do for resolvability is useful. So I hope that the dry runs and the simulation exercises as well. And also I would just simply, if I have another second, just simply to mention that the operational guidance mentions, I think encourages already banks to check with IRTs on legal aspects, on barriers to resolvability that can be removed or not. And just simply to stress that now that we have this opportunity in this industry dialogue, to stress that national resolution authorities and the SRB stand ready and encourage and expect banks to reach out with those legal issues, many of which are horizontal in nature. And derived from national legislation, and I think it can benefit as well the entire industry with more clarity on both sides from what we learn on our respective dry runs.
Makes sense. Thank you very much. We are about to conclude, so if there's a last word that is on your mind, now is the time to speak your heart out. Otherwise, I will, of course, take the opportunity to warmly thank you for having accepted the invitation, of course, and for this, I think, very insightful discussion, I must say, so I'm quite happy about it. So if there's no further remark, I will thank you, and I will also, of course, leave the opportunity to Sebastiano to thank you as well.
Thank you, Michael. No, I think it was an interesting debate and enriching for the insights provided by the two representatives of the banks. I mean, to conclude and to add to what Paola said, I think that yes, also for virtual data room, I mean, little by little, we are asking banks this year to run dry runs on their bail-in playbooks. We will probably, I mean, in the future also ask as soon as we see, I mean, a certain level of the development also to test this regarding the virtual data room. It's something that I mean can be done. Of course, requires some work or preparation, but I believe it is important to try to approximate the capabilities to set up and to have the management information system working for these purposes, to set up all the information required in a short time frame where unfortunately resolution approaches. So with this, I think that I would thank my fellow panelists, and floor back to you, Michael. Thank you.
Thank you very much. I think it's been indeed a lively debate, and that's all the time we had today to discuss separability anyway. So a warm thank you again. And I will now introduce the next panel discussion on the execution of bail-in. For this discussion, I'm very happy to welcome Enzo Serrata, who's the Director of Resolution and Crisis Management in Bank of Italy. Stefano Del Punta, who's the CFO of Intesa Sanpaolo. Thomas Gross, the CEO of Helaba. Thank you very much for joining. And last but not least, for the opening remarks, I welcome Pedro Machado, who's the member of the board of the SRB and a director for the Resolution Planning and Decision Directorate. Pedro, the floor is yours.
Thank you very much, Michael. And good afternoon, ladies and gentlemen. And I also take the opportunity to warmly greet my fellow panel members, and of course also the previous panel, also for the very rich discussion that we just heard. The introduction of the bail-in tool was undeniable one of the main breakthroughs of the BRD. And at the time of its inception, the bail-in, together with the MREL requirement, were thought as a sort of silver bullet to ensure that shareholders and creditors bear the cost of the eventual fail of a systemic institution, minimizing the impact on the taxpayer while keeping the bank in going concern. However, as we know, having the legal powers to write down capital and liabilities and to convert those liabilities into new capital is not enough. And since the SRB was created, we have been working on the two pillars for the success of this tool. On the one hand, to ensure that banks have sufficient financial resources to make bail-in credible, and on the other, to work on how to operationalize the tool to make it feasible. Credibility and feasibility are the drivers of our resolution planning work. In the second panel, we would like to focus on this last aspect, bail-in operationalization, and what is expected from both banks and authorities to ensure that the bail-in tool can be confidently implemented. Today, three specific aspects of bail-in execution will be addressed in this panel. The testing of the bail-in playbook, the operationalization of the internal loss transfer and recapitalization mechanism, and last but not least, the bail-in execution across multiple jurisdictions, especially when banks issue TLAC MREL eligible instruments under non-EU law. Starting just with a few words on testing of bail-in playbooks. By the end of 2022, all banks within the banking union are expected to test their bail-in playbooks in order to ensure that the internal processes developed by the bank to support the operationalization of bail-in are fit for purpose. As reflected in the work priority letter sent to the banks under the SRB's remit last autumn, in 2022, the focus of the exercise will be on the IMS capabilities to provide the information needed to implement the bail-in tool. However, banks are also expected to start the testing of other key areas of the bail-in playbook, such as internal execution, to make sure that the playbooks are a useful and detailed guidance to be used internally in the event of a crisis. To ensure that the exercise meets the objective to challenge the comprehensiveness and the completeness of the bail-in playbooks, banks are also expected to design a framework for regular dry runs in order to meet the expectations related to governance, so that the bail-in playbook is reviewed and improved to incorporate any lesson learned from the testing exercise, and we're sure that there are going to be many lessons learned from that. Now going and looking to the internal loss transfer and recapitalization mechanisms. This is key because besides testing the elements that were prioritized in previous years, banks are also expected to expand the scope of the bail-in playbook to cover this crucial aspect of bail-in execution. The premise of open bank bail-in resolution strategy, and in particular of the single point of entry approach, relies on the upstreaming of losses to the parent and the downstreaming of capital to an ailing subsidiary. At group level, once the resolution entity has been declared failing or likely to fail, the resolution authority needs to be ready to recapitalize any ailing subsidiary and to keep them viable. As our chair mentioned in a blog post of April last year, and I quote, by enshrining the SPE approach into the bank's financial structure in going concern, the economic commitment of a parent to its subsidiary will be enhanced over and above that already achieved by the prepositioning of internal MREL. This should also reduce any concern that the SRB might opt for a variant strategy that is misaligned to the interests of a subsidiary. In effect, the resolution authority's discretion would be materially limited. The key issue is to ensure the subsidiary is not abandoned in resolution, even in cases where the parent itself is ailing. While we can be sure that the SRB would not do so, given the objectives set out in our regulation, effective and enforceable arrangements should support the SRB objectives and provide greater certainty regarding the resolution strategy. End of quotation. Therefore, banks are expected to work on the identification and operationalization of the tools available in resolution to recapitalize the subsidiaries, together with or independently from the write-down and conversion of the intergroup instruments, including internal MREL. The upcoming revised SRB operational guidance on bail-in playbooks will further develop the section related to the loss transfer and recapitalization mechanism. In this regard, operationalization of write-down and conversion at the level of the subsidiaries of a group is paramount. As I flagged at the beginning, the focus so far has been much set on the quantum, setting the internal MREL targets and ensuring that banks start addressing any potential gap to their internal MREL. But from now on, similar to the approach taken in the bail-in playbook for the parent entities, groups need to expand the scope of this document to ensure that also the subsidiaries have in place the necessary procedures to ensure that they can execute the write-down and conversion of the relevant capital instruments and liabilities if needed, particularly in the case of subsidiaries located in a different member state of the parent. Moreover, it is important that, together with the write-down and conversion of the internal MREL, banks continue to explore possible options to reinforce the resolution's entities' capabilities to support the ailing subsidiaries so as to ensure the success of the resolution strategy. In particular, in the context of the intergroup arrangements to support the subsidiaries, banks are expected to assess the existence of potential practical or legal impediments to the prompt transfer of funds of repayment of liabilities in resolution or in the run-up to resolution, and alternatives to deal with them. For example, some national provisions may restrict the capacity of the parent entity to transfer assets to the ailing subsidiary. Some branches and subsidiaries may be prohibited from transferring their surplus resources across group entities due to potential liquidity transfer restrictions in certain jurisdictions, a problem that is further exacerbated in situations where the support may have to be provided to other jurisdictions. In this regard, those groups characterized by their presence in international markets face an additional challenge, this time related to the operationalization of the bail-in tool itself. The third topic, as I said, is going to be third country instruments, and this has a significant relevance for most of the banks in our remit. But this is also true that, in particular, large banks tend to be particularly active in tapping international markets, especially the UK, the US, and Japanese markets, to build up their TLAC and MREL stack. Currently, EU banks have a total outstanding amount of around 400 billion of instruments issued under third country law, including the UK, and assessed as eligible for TLAC MREL stack. But while international markets can provide access to a larger pool of investors and bring benefits in terms of funding volumes and liquidity, For bail-in execution, the international composition of the TLAC MREL stack poses operational challenges. The criteria for MREL eligibility try to address some of these operational hurdles by imposing a self-standing condition for liabilities issued under third country law. Besides the basic MREL eligibility criteria, the liabilities must include a specific bail-in clause and, according to the SRB MREL policy, be accompanied by with a satisfactory legal opinion. A specific case is that of UK law instruments issued on or before 15th of November 18, which is the date of the SRB expectations for banks, for which the SRB has recognized their MREL eligibility without the bail-in clause until 25 June 25, which is in line with the grandfathering of own funds instruments. These conditions are aimed at providing assurance regarding our ability to bail in these instruments, even if they are issued under the law of a third country. However, even if these third country law instruments meet all the requirements for TLAC MREL eligibility, their write-down and conversion still requires to address complex operational issues. All operational steps need to be well prepared and coordinated given the compressed timeline of the resolution weekend and the involvement of many stakeholders across multiple jurisdictions, including resolution authorities, the banking resolution, market authorities, and financial market infrastructures. We have around 180 billion of third country law instruments issued by banks which are governed by US law. And this is a topic that is of particular importance because it amounts to close to half of the TLAC MREL stack. And given the importance of the US markets for EU banks, the SRB has started to engage directly with the US relevant authorities to discuss the operationalization of the bail-in of US instruments. This work also greatly benefited from the ongoing industry initiative under the aegis of the European Banking Federation. What clearly emerged from the conversations with US authorities is that the EU resolution authorities and banks need to pay attention to the requirements set out in relevant foreign jurisdictions, in addition to the domestic legal framework, and integrate these considerations into the resolution plans and in particular the bail-in playbooks. Therefore, the SRB expects that banks cover in their playbooks the legal requirement and the different operational steps to write down and convert third country law instruments. They will have to reflect clear timelines and instructions to be delivered to the trading venues, CSDs, and market authorities. On our side, we stand ready and committed to continue working with third country authorities and industry and to address all the legal and operational issues emerging from bail-in execution outside the banking union so as to foster the interaction with banks on many of the issues that are anticipated well ahead of an eventual resolution. In concluding, I want to stress how important it is for banks and resolution authorities to continue working together hand in hand to operationalize all the required steps for bail-in execution. At the SRB, we are working to support the progress of bail-in playbooks, and together with the NRAs, we are also working on further developing our resolution planning manual in order to ensure that any potential challenge is anticipated. In the next weeks, the SRB is going to publish the revised version of the operational guidance on the bail-in playbooks, which will include new sections on the loss transfer and recapitalization mechanism and on testing. The latter aims at supporting the banks in developing their frameworks for the dry run that will have to be performed in 2022. Testing the bail-in capabilities is one of the priorities communicated to the banks by the SRB for this year. To support the build-up of IMS capabilities for bail-in, the SRB will also publish the revised bail-in minimum data list and the corresponding guidance. And in parallel, the SRB will also continue to engage with banks and with third country authorities to address the operational issues to write down and conversion of third country law instruments. With this in mind, I now give the floor to Michael, considering that we have a particular interesting mix of a panel coming from an NRA, from the industry, and of course from the SRB, which is the triangle that matters for the purpose of operationalizing bail-in. Thank you very much.
Thank you, Pedro, for those opening remarks. Let's open up the dialogue, maybe with a quick reminder that participants in the audience are also very welcome to provide their remarks, feedback, and questions to our panelists. So feel free to use the Q&A functionality on the right of your screen. A lot of things have been mentioned by Pedro. I'm tempted to start with one, which is third country insurances. And in particular, so the appeal of being able to tap the capital market of outside of the EU, the US, of course, but more recently, the UK has become one, which can be appealing for a variety of reasons, and we would like to hear from you about that, but can also bring its lot of difficulties, legal difficulties and operational difficulties when it comes to the possibility to bail those in. So maybe my first question, and I'm looking at Stefano Del Punta from Intesa first, which I think you are also indeed using those possibilities of funding from the US and from the UK. Maybe first, what drives the appetite? Is it the ease of funding? Is it just plain diversification? The need to conduct some business in the US or the UK? And do you see a trade-off between going and gone concern consideration? And how do you strike a balance in that regard with the extra maybe legal cost to make those insurances bailable in Europe?
Good morning, everyone, and thank you for having invited me in this, I think, very interesting panel. And of course, I heard very, very carefully all the remarks that Mr. Machado made, and I understand that 22 is going to be a quite intensive year for banks and for us, of course, in terms of doing the test of the playbook, MIS, etc. And this third-party issuances, I think, is a very strong point. I have a certain background in my professional life because before being a CFO, I've been named CFO in 2013. So I'm as you can see from my hair, at this point, I can consider myself as an experienced CFO, so to speak. But before, I've been for 11 years the group treasurer. Okay. And Intesa has been the first Italian bank, because now UniCredit has also followed our example many years later, to go into the US market as a Yankee issuer. At the time, of course, we were issuing almost everything in the international market under UK law, because of course, the UK was still part of the European Union. We started issuing in the US market in 2010. After a long preparation, I have to say, because the idea of an Italian bank going in the US market, 2010 has been the year of the sovereign crisis in Greece, etc., etc. So it's not been easy to go and sell the name there. I have to say that this has been for us probably the most important pillar of our resilience in the subsequent liquidity crisis that unfortunately affected many peripheral countries when unfortunately the Greek problem was so to speak exported to other countries, including of course Italy, Spain, Portugal, Ireland. And I have to say that our ability and the fact that we have opened up the US market has been I would say the key pillar of our ability to remain liquid. At the point it was impossible to issue anything in the euro market. If you look at the track record of issuances, not only Italian, Spanish or Portuguese bank, but no banks actually was issuing bonds in the market. At the time, of course, you could revert to your retail investor base, and a lot of government guaranteed bonds has been issued, but this came later, okay? Came later, but we were basically the only bank in Italy who managed to stay afloat, to continue to give credit to our clients. And this was because we managed to do a couple of large issuances in the US market. At a price, of course, at the price. I don't remember now exactly what was the spread over LIBOR that we paid, or the fixed rate equivalent that we paid, but that was, I mean, something that probably today you could issue easily additional Tier 1 or even more than that. But still, this allowed us not to close the credits and to make so the crisis in Italy less severe than it would have been otherwise. And it has been severe, as you know, okay? So it is really essential that banks can maintain a diversified investor base. This is the most important part. Don't forget the euro market, the single market is still in the making. Okay, there's no way to compare the depth, the resiliency, and the liquidity of the US market with what we have in the euro market. There are times the euro market is pretty much, I would say, sort of bandwagon market. I mean, there are times where everybody can issue a decent condition. There are times where very, very few banks can access the market when things get tough. US market is different. This market difference, if you are a name that is known there, if you have your investor base, you've been loyal to your investor base, at a price you always can find something. And I think the UK market is also similar, especially the sterling market is an important way of diversifying issuances, especially in the long term. UK is typically, sterling is typically very long-term market. You can issue maturities that is impossible to tap on the euro market. So I mean, now we are also looking at the Asian market, etc. But this is more is a more fragmented market. The big guy there, China, is not open to foreign issuances. So it's more for the future. But for the time being, it is essential that bank can continue to issue third-party jurisdiction. We issue about 30% of our bonds in dollars, and it is important that you are perceived as a, I don't want to say frequent issuer. Of course, we never be a frequent issuer as a U.S. bank, but or a foreign bank that has a significant activities in U.S. We only have corporate banking activities in the U.S. as many other banks. Still, we go there also sometimes paying a little premium depending on how the cross-currency market goes. Sometimes we pay premium over euro, but we want to remain active. We want to be perceived as a consistent issuer. I personally was traveling at least 3 times a year to the US to meet investors. Now I do that, of course, on a video, but still I make hundreds of meetings a year with US investor on fixed income base. So it would be a big mistake to somehow make these to stop these, or to make this not possible, or to, in any case, make this less palatable, so to speak, for moral purposes.
Stefano, if you allow me for a quick follow-up. So
yes.
We understand the extra liquidity that is appealing, but that come at a cost. What about the more specific legal cost, possibly, of also ensuring that those can be bail-inable?
Well, I mean, we have inserted Article 35 at 0 cost, because I mean, we are going to professional investors. All these investors know very well that there is a risk, and that of course. So we have also made some. We didn't do that, thanks also to the grandfathering of issuances pre 2018. But
for the UK.
For the UK, for instance, but we were about to do some bondholders meeting to change, let's say, and insert Article 55, and that could be done basically at zero cost. We had to put maybe 1-2 basis points on the table just to be sure to get the quorum in the meetings, because there's no investor in the UK and the US that really believes that they will not lose money if Intesa falls into troubles. So this is embedded. So our legal opinions are pretty strong. Of course, there's no US legal house. I don't think. I think it's the same also in Europe. They will tell you 100% sure you can do that, but the legal opinion, in my opinion, are pretty strong that these can be bailed in, and that there is no significant risk that a court in the US or in UK would then revert a bail-in decision from the SLB. So this is our position. Is very strong. Would be a big mistake to decrease the level of diversification of our investor base. It would be a big mistake. And if bad time comes, something we have seen in the past in 2010, 2012, 2009, etc. The fact that banks would be somehow restricted to issue in their domestic market would be an element of a very significant weakness for banks. So
thank you. Thank you, Stefano. Very clear. I'm turning over to Thomas Gross, maybe to complement. I appreciate that Helaba has a very different approach to funding and its funding mix, but if you have maybe something to add on top about the third country insurance, and if not, I would of course also welcome deep diving into also the issue of internal MREL and transfer of losses internally to the group. Thomas, thank you. The floor is yours. Thomas, I think you're on mute still. Let's check. We can hear you. Let's take 2 minutes. Let's leave maybe 2 minutes to sort the issues. After what's been said from Stefano from Intesa, maybe a comment from Enzo Serrata from Banca d'Italia to complement on this.
No, nothing to complement. Of course, Mr. De Punta is in the best position to face this decision. In our opinion, in the opinion of the SRB, we are very happy to hear that the clause is not so difficult to be implemented in USA and UK market, and we are very happy to understand that the legal opinion is quite strong. So this is a very important issue. So, and then in very important achievements for the bail-in execution cross-border.
No, of course, thank you. So while we are waiting for Thomas to come back, I can see there's actually a question on the Q&A if someone wants to pick up or a remark. Besides the need for diversification of financing sources, isn't there also a question of limited capacity of the EU market to absorb the insurance? I think it was emphasized by Stefano's remarks indeed. So it doesn't appear as an obligation to tap other deep and liquid markets. So I guess the question is more on the EU market capacity to absorb such insurance for the banking sector. If someone wants to react on that.
I can jump in, just I think building up also on what has been said. I mean, what we clearly see from the experience with, in particular, the large banks, but also not only the GSIBs or also at the top tier banks, is use the ability to tap those markets precisely in line with what Stefano said, to diversify the investor space. We acknowledge that, and this is very clear from the figures that we have at our disposal. Our perspective is not so much in terms of questioning this ability, and we would not even question the funding strategy and, of course, the ability on the diversification strategy by the banks. We position ourselves from the angle of ensuring that those issuances, so the programs or the prospectus, and the contractual documentation that underpins those issuances, as indeed the sort of contractual recognition clause, or it is done in a jurisdiction which enjoys statutory recognition, by the way, which is another form of recognizing bail-in. So we are there to scrutinize that requirement, which, by the way, flows from the BRD, and which we have then sort of even strengthened by means of our SRB MREL policy by requiring a satisfactory legal opinion. And then we have put forward in our SRB MREL policy what we understand under a satisfactory legal opinion, which means that it has to match certain requirements, which ensure us, which give us quite reasonable and adequate degree of certainty as regards the enforceability and effectiveness of that clause in the jurisdiction which governs, or which law governs those issuances. What we are, and it must be said that banks have been quite, let's say, have been particularly keen on delivering meeting that standard and following with qualified legal opinions those aspects. The other dimension, and maybe this is more the topic here of the panel, is really operationalization. So when it comes to the concrete write-down and conversion of the instruments in a bail-in situation, and that's where, under US law in particular, we are seeing that further work is really required to be sure that this is fully attainable, that sort of operationalization is fully attainable, in particular when it comes not only to the write-down but then to the conversion in issuance under the US law, or for US investors, sorry, for previous holders of those liabilities, which means that there we have to follow and try to match, in terms of operationalization, what is called the DTC's operational arrangements. So this is DTC is the CSD, where the US instruments issued by banks are deposited and settled. And this covers terms and conditions on eligibility requirements, on payments in non-US currency, mandatory organization. So there is an array of issues that we are now discussing and engaging, also benefiting, as I said at the beginning, from the project of the European Banking Federation, with a view to find a suitable and, as I said, feasible way for that conversion to happen without any risk. Stop here because I think Thomas is already connected.
Thank you, Pedro. No, indeed, it's with a great pleasure and a tiny bit of relief that I can see that Thomas is back with us, and I think we can hear you. So Thomas, if you need me to repeat the question or...
No, I've got everything, but I don't know why.
Thanks for your agility.
Yeah, no, I can pick up the question, and thanks for inviting me to that panel first. And secondly, now I shifted the computer, and hopefully you can hear me. Yeah, well, I pick up both the topics you mentioned, but focus much more on the second one. Why? I think it might be helpful just very, very briefly to give a brief structure on Helaba Group, and then I can better explain what is, let's say, the focal point of us. So we have about a 200 billion balance sheet size, which is a kind of mid-sized bank. And Helaba, as the bank, is basically the parent company. And we are also considered as the single point of entry. And we do have 5 subsidiaries. In the parent company, we have allocated basically all of our wholesale business, also the funding activities. when our subsidiaries, they are dedicated to different business lines. And important there is one retail bank, which is the Frankfurter Sparkasse, which belongs 100% to us, as all the other subsidiaries do as well. So that's basically the structure of it. We are focused to some extent, obviously, being a central bank for almost half of the German saving banks on Germany, but not only. We about 2/3 of our business doing in Germany, 1/3 abroad, being present obviously in many countries, but focusing even on our international business on EU. So we have basically more than 90% of our assets and our business is done in EU countries, which makes it a little bit less complex and complicated as maybe for some others. And with regard now the bail-in execution and the non-EU issuance. So with regard to long-term funding, obviously, as we are also a real estate company, we do a lot of covered bond funding. And the senior long-term funding we do just entirely in the EU. So that's why, luckily, for a lot of reasons, we are not exposed to this kind of legal issues. We do it for cost reasons for many, many years. As we are, as I mentioned, doing our long-term funding also within the saving banks family, we do have also access to a lot of private placements, as well as big jumbo, let's say, issuance in that regard. So non-EU funding is not, let's say, a topic for us. It's a kind of different if we get to the second topic, the loss transfer mechanism between Helaba and our subsidiaries. There is the focus point to our, as I mentioned, retail bank, about a 20 billion retail Sparkasse, one of the largest ones in Germany. And there, for us, we have chosen the internal MREL entirely as a mechanism to deal with that. So as I already mentioned, Helaba, the bank, the parent company, is considered as the point of entry. And hopefully in the very, very unlikely situation that both of us, Helaba Bank as well as the Frankfurter Sparkasse, will go into resolution, we have built up a sufficient already large layer of an internal MREL, and therefore we can ensure that the transfers of losses can be done swiftly, let's say, from Frankfurter Sparkasse to us or via the other way. So on top of that, we do not see the need for any additional loss transfer agreements because we are focusing entirely on this pretty large layer of internal MREL within Frankfurter Sparkasse. So hopefully remembering the two questions you mentioned, even though shifting towards another, let's say, room.
No, but thank you. That's very useful. Maybe before leaving the floor to Enzo, I just wanted to know if, because of the specific nature of Helaba, if this internal transfer mechanism, if there's any specificities that would be worth commenting on, again, given the specific nature of Helaba.
As we, let's say, as well, Helaba as well as the Frankfurter Sparkasse, we are not a privately owned company. Obviously, the legal, let's say, environment is based on our public ownership structure. But there are no, let's say, there are some specific, obviously, let's say, dealings we have been through and have fixed. But in essence, it's the same way of transferring and shifting those funds as you can do in a privately owned company. So we basically build it in a different framework, but in essence with the same mechanism and target as it would be done on a 100% owned private company basis. Yeah.
Thank you, Thomas. Also, kind of related to one question that's been asked on the chat, banks might find it sometimes difficult to develop the playbooks also vis-a-vis some of the expectations that NRA can have, also from the perspective of MREL instrument, but also non-MREL bail-enable instrument. And I wanted to hear from you, Enzo Serrata, if you don't mind, what's the approach of the Italian NRA to ensure a clear and timely communication on the work of bail-in playbook and execution?
Yeah, thank you, Michael. First of all, thank you very much for inviting me in this industry dialogue and for the question that allows me to present Banca Italia approach to reach an effective preparedness to bail-in execution in a domestic perspective. Indeed, of course, as already known, NRAs have an important role in resolution execution, and in this context, obviously, the bail-in execution is a crucial issue. I hope that this experience could give some suggestion to improve the preparedness of other banking systems. So adapting an expression that is dear to our chair, preparedness to bail-in execution is a long journey, and we are making this key contribution, and this journey with the key contribution of the industry. As a national resolution authority, we started this journey some years ago in 2019, bringing together all the stakeholders and players potentially involved in a bail-in transaction. That is the Single Resolution Board, of course, the Italian banks, the Italian Banking Association, the market infrastructure, and the Italian Market Authority. In particular, we held a workshop with the participation of the SRB to discuss two main issues. On one hand, the continuity of assets in FMIs in a resolution, and the main issues related to the bail-in execution. As regards the first point, we registered good achievements, in my opinion, with the Italian FMIs revising their internal regulation were needed to make them consistent with the resolution framework. And as for the bail-in execution, Banca Italia presented in the workshop the key elements of the bail-in execution model in the light of the Italian law transposing the BRD. And that is the direct write-down and convention. So at the moment, we don't use the interim instruments. And asking bank and market infrastructure to elaborate practices to execute possible bail-in orders issued by the SRB and by the Banca d'Italia. Today, I can say that the workshop opened an important dialogue with the industry, which has spanned over the last 2 years and marked significant steps ahead. Indeed, Banca d'Italia, after the workshop, promoted the establishment of a dedicated national task force coordinated by the Italian Central Securities Depositors, Monte Titoli, that, as you know, now is part of the Euronext network. And this task force was aimed at defining in a domestic perspective a procedure which identify roles, timelines, and operational steps for the management of the financial instruments that can bail in case of resolution. The Italian Banking Association and the major Italian banks participated actively to this task force. Also, Banca d'Italia Council took part as observer. And it's fresh news that the task force has substantially concluded its work, so that the final report will soon be available to all stakeholders. So this is an important achievement, but of course there are aspects that deserve further step ahead. As a national resolution authority, we hold a constant exchange with banks in order to support them in drafting the bail-in playbooks. This is, of course, within the IRT. And this continuous dialogue and the commitment of Italian bank led to documents that, in our opinion, even if there are, of course, areas for improvement, in my opinion, overall shows completeness and accuracy, even if, of course, there are also other points that still deserve operational development. As to the interaction with market authority, Italian market authority, CONSOB, we have in place protocols and memorandum of understanding aimed at regulating a prompt reaction of a crisis. There are other steps are needed, in particular, to formalize the operational steps. But let me say that the cooperation in the past cases with CONSOB was always time and effective, and we concretely experiment that in the resolution that we have in 2015 for the resolution of 4 medium banks. Finally, in 2020, Banca Italia approved the National Resolution Handbooks, which complements the SRB Resolution Manual, taking into account the operational steps document and the templates for drafting the resolution scheme and the implemented order of the SRB. We have now a comprehensive framework for the resolution execution. But in any case, we are now engaged with the SRB in order to update these national handbooks with the improvement of operational steps documents and the template for the implementing order. As Pedro was recalling before, now we are after have done important progress in unfolding the procedure for the executing the bail-in. Now is the new frontier is testing them concretely. And as Pedro was recalling before, for 2022, the objective of the SRB is testing the internal bail-in execution. And so, as Mr. De Punta was saying, 2022 would be an intense year for banks, but let me say that would be intense also for the national authorities. Thank you very much.
Thank you, Enzo. That's very clear. I'm tempted to hear the opposite view, or not necessarily opposing, but from the industry about how to improve also on the state of play in terms of the clarity of expectation in the dialogue with NRAs and institutions in general, and also vis-à-vis indeed what's going to be a big dossier for 22 on the testing the bail-in capacity, as Stefano was cheekily suggesting that some of the investors are not worried about those to foresee any bail-in. Yet testing the execution of such bail-in is probably very important. So I'm keen to hear from Thomas and Stefano also on those aspects.
Okay, maybe I can start. Of course, we recognize that the playbook must be tested. I heard very well and took good note of what Mr. Machado said about being sure that all the nuts and bolts are being put in clearly in the playbook when it goes to all the steps and processes which are necessary to bail in a security, an instrument in the US market. And that, of course, has its complexity. Of course, it's a different payment system, it's a different clearing system. DTC is certainly, we had to go through very complex processes, for instance, in terms of the withholding tax on our coupon and the registering the possibility of paying without withholding tax. Of course, it's very different in the case of US investors than it is for European investors. So we understand the complexity, operational complexities of the US market, and of course we're very keen to work with with Banca d'Italia and SRB on this. I have to say, to be sincere, let's say the SRB and the Bank of Italy NRA section, let's say, are not the only authorities, are not the only supervisor we have to deal with. And I'm not saying this because I'm a guest here or because SRB is hosting this event, but really the degree of cooperation, degree of the fluidity, so to speak, of the work with SRB has been something that really is not comparable to the others. Really, we have more than an excellent relationship. We also, I think, have been, if not the first, among the very first banks to receive on-site inspection. SRB event, of course, was an on-site inspection which has been conducted off-site because of COVID, and we received a letter that I personally read to the board, really witnessing the degree of cooperation, a degree of very good and fluid. So I'm sure that we will manage to solve all the issues when it goes to third party, and that the test will be an important pillar of this upgrade of the playbook, in a sense. Maybe a couple of things that I would like to add before closing and giving the microphone to Thomas. One, on the internal MREL, our position is very clear, even though we are, of course, a very different situation than Helaba. We own 100% our subsidiary. The idea is that all the MREL eligible liabilities of the subsidiary are subscribed by Intesa, which then is the only entity that goes in the market. And of course, the way the bail-in is done by simply writing off what is needed on these bail-in liabilities. So going enough subordinated liabilities, so to speak, to all our subsidiaries, so that without doing any conversion or issuances of new share, we can simply go with the write-off, with the bail-in of these subordinated liabilities, and restore any potential subsidiary that would become non-viable. So we really try to keep it as simple as possible. We have other complexity, for instance, understanding how to go with DTC to bail in US investors. So we try to keep this as simple as possible. The other is that, of course, on the MIS, we have done, I think, a good effort, but I really call for the understanding of from the SRB that we all want to go to a situation where a bank can be resolved at the push of a button, but banks are really now in a situation of very critical situation, in a sense, because all the banks, including us, are rewriting completely all our core banking systems, because of course it's not cloud compatible. There is, of course, a totally different value proposition to clients. Clients, especially the pandemic, has accelerated the move of clients from physical channel into digital channel, and this is putting a lot of pressure on banks of rewriting completely their IT. So of course, these, I think, should be taken into account in the requests that are done to all the banks when it goes to all the MIS capability. So we've certainly tried to do the maximum effort, but the context is very complex because all the banks are doing a huge effort on their IT system. So this is just something that I wanted to add. Sorry for having been maybe too long, but give them the microphone to you.
Very clear, Stefano, and Thomas, you'll excuse me, I will leave you the opportunity to repeat the praises from Stefano in a minute. Enzo just wanted to make a brief comment on something Stefano just said.
Yes, thank you. A very brief comment. We perfectly understand the difficulty of the bank in this difficult environment. Let me stress that the dry runs are important steps to verify concretely the resolvability of the banking group under the resolution assessment of the SRB. But on the other hand, these exercises are intended not only to test bank capability, but also to refine practices and guidances of the SRB and national authority. For example, data provisioning for bail-in purposes, which accordingly to our banks require important investment. So the dry runs would be quite important also to have feedback on the bank in order to refine and possibly minimize the cost of the, for example, the managed information system. So also dry run should be another means to improve the dialogue with the banks and more in general with the industry. So in my opinion, it's important for banks even if we understand that the environment is difficult to put all the effort needed for the success of this simulation.
Absolutely, and we will.
Thank you for this clarification, and Stefano, we will take your words on that. Thomas, the floor is yours. Sorry.
Yeah, no problem. So, well, I think right from the beginning, Pedro has mentioned a lot of expectations, what are to be expected or are already on the table we have to fulfill. Yes, I think for me, there are two important things. So first of all, I would once again also stress the fact that as let's say also Intesa and a lot of other banks, we are, let's say, heavily investing in our IT systems, in our data management for a lot of reasons. And obviously, we should also have right now as much as clarity that we can use this new data pool also for, let's say, IRB and resolution purposes. Not exactly, but as soon we do know it, we are, I think, now much better prepared than 1 or 2 years ago. I think this is a very important. And as always, you know that IT projects will take some time. It should be acknowledged that at least to some extent there are workarounds needed. And in 1 or 2 years time frame, it is part of our, let's say, new data management and IT system. So this is just a matter of fact, and it's not, let's say, complaining or something like that. It's just, I think it could be sometimes a bit more tailor-made to the long-term efforts that banks are anyhow doing. Secondly, yeah, testing, it's important. Trial runs are important. Why? They are always important, but especially on this topic, this is not something you would like to realize and be in. You probably, or sometimes you as a person will not be the one who is in charge if, let's say, the playbook gets into reality. And therefore, I think for the entire organization, it is very important. And I think also with regard to the communication, yeah, we have made a lot of progress over the past few years on both sides. I think on both sides, and now we are on a level that I think we can really openly share what are some obstacles, what are some problems, and to find specific, to some extent, tailor-made solutions, obviously within the framework that needs to be applied by everyone. So yes, I think we are much better. Is there room for improvement? I think definitely. But that's why we are here, why you are here, to further improve the level of communication and then the testing for the event that hopefully never comes, at least for the acting management of most of our banks.
Thank you very much, Thomas. That gives me comfort that there's going to be some very interesting discussion to continue having in the future on the topic. Before concluding for the next item on our agenda, which is still within the same dimensions, because we're going to talk about MREL and the MREL policy planning cycle. I would like, of course, first of all, to thank you again for accepting the invitation and for this very insightful discussion. I've learned a lot myself, so I'm very happy to have heard from those various perspectives. And I will, of course, leave the floor to Pedro for a concluding remark and the opportunity to thank you.
Well, thank you very much, Michael, and also, of course, thank you very much to, again, renewed thank you from our side to Enzo, Stefano, and Thomas for having accepted being part of the panel. I think this demonstrated the discussion that indeed we have to work together on the operationalization of bail-in. What I think was key here to understand was also the perspective from the banks. And I think this was very well emphasized by Stefan on the importance of tapping the international markets and how this is important in terms of diversification, but with the safeguard that it has to be ensured that for those issuances to be eligible, they have to meet certain requirements. So we have seen that banks have been meeting, at least in terms of the legal opinions, they have been providing opinions that qualify for the purpose of being qualifying, at least for the purpose of having safeguards in terms of effectiveness and enforceability. But there is still a work to be done, and this is also acknowledged by the industry, in at least in particular for the most deep and liquid market, which is the US market, to really tackle the issue of personalization, and eventually for the conversion, which is a key issue for rendering bail-in operational and feasible, really going for in particular, working on the alternative conversion mechanism, which by the way is amply used for private issues. So this is on the one hand, and I think in this respect, the discussion has been very rich. And of course, coupled with then the way one really deals with international, the loss transfer mechanism at the level of an SP strategy, and how one goes forward with the building playbooks. I think the role of NRAs has been clearly evident. I mean, the support and the guidance that NRAs have to provide is key. We have also to be mindful that in many jurisdictions there are specificities that depend also on the additional guidance that NRAs provide for operationalizing the building playbooks and for feeding the building playbooks. But for that, to be sure of that, testing is essential. So that's why dry runs will be a priority, because bail-in playbooks are also an operative and living document. They have to be fed. And then, of course, the crucial importance. I think Thomas was very emphatic and very clear about the strategy for dealing with losses at the level of in the group strategy and an SPE strategy. From our side, what we have to be clear is that reposition MREL or internal MREL might not always be sufficient to cater for the losses and the recapitalization needs of subsidiaries in a resolution scenario. And in that regard, it is key for us to understand how a bank deals with which funding procedures, financial means has in place to really upstream losses and downstream capital if that reposition internal MREL is not sufficient to cover the losses. And for that regard, be aware to be mindful and be, from our perspective, aware of where, if there are legal impediments or if there are operational impediments, is key. And that's what the work that we are going to do, in particular, invest a lot in this year together with the banks. So from our side, just to renew again my thank you. It was a pleasure to share this panel with you. And now up to you, Michael. Thank you.
Thank you, Pedro. And without further ado, it's my pleasure to welcome back Sebastiano Laviola for a quick presentation about the MREL policy planning cycle. Sebastiano, thank you, and the floor is yours.
Yeah, thank you, Michael. Thank you to all the other panelists for the second round, which was also quite interesting and insightful. I would ask the colleagues to put the slides on the video so that it's easier for participants to grasp the contents, because there are a few numbers that I wanted to provide, and therefore this would be complicated. I think it is a colleague that is going to share them. They are also going to be put on the website, if I'm not mistaken, but they should arrive.
In the meanwhile, then, just to while colleagues are setting up the screen, I would maybe like to reiterate the fact that we welcome remarks on the chat, and also feel free to let us know if you prefer this new format for the industry dialogue compared to last year, and if you appreciated this new format. Sebastiano, the screen is up. The floor is yours.
Thank you. So here there is a short update. And it is important that as before going to the presentation, what Michael has just shown in the chat, if you can be so kind also to provide your views on this new format, so that for the future we have an impression of what is better for this dialogue. Now, quickly on the MREL dashboard and policy. If we can go on with the slides, please. So the first one is the dashboard. And here, just a few numbers. I will put the attention only on a few numbers as update for those colleagues that maybe have not noticed what we have recently published. These are the external targets of the MREL policy as of last September. So you see that the overall amount, the target is 26% of the risk-weighted assets, essentially, that in our jargon we call TRIA, including the capital buffers, and 17.6% for the subordination. The shortfall has been much reduced. You see in the last bullet, it is 20% less than the end of last year, and it is in absolute amount 34 billion and 0.5% of the TRIA. Let's move to the intermediate target, which is the one that effectively is already in place, already in force. You know that the binding intermediate target kicked in 1st of January. So if we can move the slides, the average intermediate target stood at 25.3. The shortfall is very low, 5 billion, always in Q3 21, negligible as concerns the subordination part, and the shortfall reduced by about 1/3. But again, let's go on. These were the external target. What is the internal target? The internal target, which is also binding as of 1st of January, so last month, the average was almost 24%. At September 21, but we had here more than half of the non-resolution entities in scope reporting a shortfall. So you see that the shortfall is a bit higher than even the external one, and the average internal MREL intermediate target amounted to 21% of TRIA. Here, the entities in shortfall were 29, with respect to more than half of the sample that we had, so about 40 for the final internal intermediate target, and here there was a shortfall of about 11 billion. There is a distribution across countries and in the various quarters, but I will not lose time on that. You will have the slides on the website. As concerns the build-up, you know, we are still in the transition period, and this is effectively the first formal year of the transition period. The build-up tells us that the stock of MREL liabilities, including the own funds, is essentially 1/3, almost 1/3 of the denominator of the TRIA. So it is more than 2,200 billion, a little bit increased from the end of 2020. You have also the amount of the subordinated capacity, also sizable. What about the build-up for those that took the opportunity of the buoyant capital markets in order to issue liabilities? There has been about 43 billion of MREL eligible instruments in the 3rd quarter of the year, a little bit decrease with respect to the Q2, but so not a little bit, but somewhat decrease. But this is also the pattern that we have seen in other years. The focus was mainly on senior bonds, and the G-size again issued the highest proportion of the instrument, followed by the top tier. Cost of funding, finally, here not relevant news. You see that the curves in the first chart and the upper right, I mean, have maintained the same pattern. Therefore, we are close essentially to the pre-COVID-19 levels. The issuance in here we have, of course, more updated information with respect to Q3. We have Q4 21 was slightly lower the amount of issuance of bonds with respect to the Q4 of the previous year, so Q4 2020, and fluctuated around the lower part of the corridor that has been built over time regarding the issuances. Here it is the years 2015-2019. I would now, so this was the update regarding the MREL targets and the cost of fundings and the build-up. Let's move to the MREL policy update for the calendar year. Here, a first important message to convey is that sorry, here there is a mistake in the bullet. It's not the 21 MREL policy in the first bullet, but it's 22, of course, as the title says. A little mistake. This will be substantially stable, subject only to targeted amendments and incorporating what we call the quick fixes of the banking package. That's to say, what concerns the treatment of chains of subsidiaries for the purposes of internal MREL, and also the treatment of banks which have adopted an NPE strategy. So this is called, in our jargon, CRR-BRD quick fixes. And it is now under final trilogue strategy, I think, between Council and Parliament. Then we have, and on this I will say now what will happen. That's to say that we will implement the proposal in line with the application date of the new legislation. We will see what will be the final text, and as a result of that, we will apply in the policy the determination of the legislation. As concerns the internal MREL, as already known and announced, we are enlarging the scope of the Euro resolution entities subject to internal MREL. So each year we get closer to the final steady state. And on CRR discretion of leverage ratio, here there will be a slide regarding possible reaction from the SRB regarding the temporary supervisory measures taken by the banking supervisor. And finally, you will find in the MREL policy, when it will be finalized pretty soon, you already know the provisions of the draft regulatory technical standard, which has been transformed essentially into an SRB policy in order to allow banks to issue according to what we believe will be then endorsed by Council and Parliament, and of course well received by the Commission. According to these provisions, then we allow the bank already to move very, very close to the final delegated regulation, and therefore to have this policy in place already from the last 1st January. As concerns finally the eligibility, here we revised, but this is already something known for the participants that follow our website. We have, as a result of the introduction in the legislation of eligibility criteria, we have revised the checklist that we already published last year, where we provided more flexibility for the level of signature of the management. We updated the form and the checklist, which were published in December 21 on our website. and this has to be used together with the MREL TLAC reporting as of the end of last year, and the first submission that we expect is in February of this year. So, I mean, in a few days, we will expect the first reporting. If we go on no credit awards off and changes to the MREL methodology for NPE banks, here, as announced last year, we are assessing the possibility to reflect more elements in the no credit awards off methodology. You know that we have a tool that allowed us already last year to assess in a more holistic and more complete way the possibility of risks of no credit awards off. And this year, as announced, we have reflected in the policy the possibility that the balance sheet will change when the failure is approaching. And therefore, I mean, the assumption is that part of the short-term unsecured funding is considered withdrawn and replaced by secured liabilities, which of course may have an impact on the no credit awards off risk. And in the future, to say for the 23 cycle, as also announced, we will consider the potential impact of the discretionary exclusions on the no creditor awards off risk. The potential the discretionary exclusions are clearly envisaged by the legislation, and we would like to assess, as I said, the potential impact. On quick fixes, I already explained the legislative time frame, and here just two elements to be underlined. One concerns the case of the NPE strategy, so those banking groups that use an NPE as a main resolution strategy. Here, the focus of the change is on third country resolution framework. That's to say that if in NPE subgroups outside of the European Union there is a surplus with respect to the calculation of the requirements in that country, this can be used by the NPE group in the European Union only if there is a resolution framework in the third country. And that's to say, this surplus can be used to lower the impact at the level of the European Union NPE group. But if there is not a resolution framework, then this will not be possible. So this is a clarification of the legislation, which was already in part embedded in the previous text, but not entirely clear. Therefore, the Commission decided to clarify it once and for all. For the daisy chains, as I said, the chains of subsidiaries, we expect that the banks prepare. I mean, you may know that here there is a mechanism of deduction in order to essentially, if there is a chain of subsidiaries, to achieve the same situation as a direct essentially issuance by the last subsidiary in the chain directly to the parent company, and therefore in between there are deductions in order of course to avoid the illusion of the requirement. And we expect therefore that the bank that have long chains prepare for the new deduction mechanism, and we will monitor the compliance. And in general, we would expect that the chains of subsidiaries are really used when it makes sense for business purposes. If you can go on in the last couple of slides. The update on the threshold here, it is well known to the participants that have confidence into the resolution domain. Here it concerns, as I said, the lowering of the threshold calculated in percentage of the group's total risk exposure amount or leverage exposure or total operating income to identify non-resolution entities as relevant legal entities. either they are above a certain threshold or they provide critical functions. This is consistent with as last year, but only the percentage goes down from 3 to 2%. But we have also added a criterion, which is that total assets are above 10 billion, irrespective of the threshold, total asset of the subsidiaries, of course. And you see in the chart clearly what are the conditions. Also, all these is well known to the institution, to the banking institution, because in terms of statistical reporting was made clear already since October last year, because we need the information in order then to calculate the requirements during the resolution planning. The other point, if we can go on, it is so this is the discretion which is embodied in the capital requirement regulation regarding leverage. As you know, there is a discretionality given to the banking supervisor to use this discretion to temporarily exclude certain exposures to central banks from the calculation of the total exposure measure. During the pandemic crisis, the ECB as banking supervisor used this discretionality, and in September 2020 communicated its extension until March 22. Banks may benefit from this measure, as I said, until end of March 22. We do not know. It will depend on the conditions and on the rationale followed by the banking supervisor, whether to extend it or not further. This is, however, always in presence of exceptional circumstances. And as concerns the resolution requirements, so the MREL requirement, the leverage ratio requirement and the leverage amount can, of course, influence the calibration of the final MREL targets, simply because there is a disconnection between the timing of the calculation and the reference date of the requirement. So this would influence the compliance with the requirements of 1st of January 24, but also the calibration in ongoing. So what will the SRB do, and what announced in the press release released in December? We will collect the necessary data in case the ECB discontinues the measure, and we recalibrate the final targets in the 22 resolution planning cycle on the basis of the changed leverage amounts and requirements, so that in every circumstance, every bank will play not less and not more than it is a real requirement. We will also monitor the compliance towards the final MREL target, because of course the requirement has to be respected also in ongoing, not only in 1st of January 24, and this will also be taken into account in the calculation. And we provided already to various organizations several explanations on that. Finally, the prior permission regime, so-called prior permission, you know that this is essentially as a result of the new banking package, the need for banks to obtain a permission from the resolution authority for our banks from the SRB to reduce the MREL eligible liabilities. The types of authorization are two: the general prior permission for maximum 1 year, and the ad hoc permission, meaning instrument by instrument. The EBA published the requested by the legislation final report on the draft regulatory technical standard on permission regime. The Commission is now assessing and transposing it into a delegated regulation, which has to be approved by the co-legislators, in order not to prolong the transitional regime that the SRB had in place, but which had provisions different from the ones of the RTS. We essentially, during the summer of 21, we incorporated the regulatory standards draft provisions into the SRB policy, and we issued a guidance on the website. And in order to allow the banks to file the applications as of in time to be authorized from as of 1st of January 22. And these, in our view, unless the Commission makes substantial changes to the draft RTS, will allow the banks to continue according to this authorization without instead replicating the process of authorization, so being authorized according to the provisional transitional policy, which however has a number of differences with respect to the draft regulatory technical standards, and therefore then being authorized twice with a lot of burden, both for intermediaries and for the resolution authority. Just a few statistics on this, if we can go on. The predetermined amount, as you know, the slide before, as you know, cannot exceed 10% of the total amount of outstanding eligible liabilities. This is in the draft RTS. We can see that we can say that the bank that applied for a general private permission have not used the full predetermined amount, except for a few examples. And then there is also a margin to be met above the MREL requirement, always for general prior permission, after deducting this amount that it is requested to be used to redeem instruments. This margin has to be set by the resolution authority in agreement with the competent authority, and this happened between the SRB and the ECB. We have no other agreement for the time being as regards the banks that are under our remit, but not in the remit of the ECB. So the cross-border LSIs, so cross-border less significant institution, simply because we have not received any request of application from these few number of banks. In terms of the statistics, as I said, last slide, we have received as of recently 51 permission applications, vast majority for a GPP, general prior permission, 5 ad hoc reductions. Out of these, 40 were from resolution banks, 11 were from liquidation entities. As you know, the legislation does not exempt the liquidation entities, even though the MREL requirement is the loss absorbing capacity, so it is equal to the capital requirements essentially, plus the CBR, does not exempt the liquidation entities from the authorization. But in the draft RTS, a simpler procedure has been identified, and then we will have to see, and we hope that this will be confirmed by the Commission when transposing the draft RTS into a delegated regulation. I thank you for your attention, and sorry if I took 5 minutes more.
Thank you very much, Sebastiano. It's been a pleasure to be your host, and it's also my pleasure to thank all the many participants and to give the floor for the last intervention. Our speaker will be the chair of the Single Resolution Board. Sorry. Please welcome Elke Koenig for the closing remarks.
Thank you, Michael, and thank you to all for this beautiful speakers for the really lively debate on these important topics. I'm a bit tempted to say, knowing Sebastiano, that it's hard to stop him when he starts to talk about MREL. I already knew that I have to shorten my final remarks to make up for him. But let me again say, I think the change in style or in format for me was working very well. I think we've had very interesting panel discussion. I won't repeat it, just perhaps to use one undercurrent in the discussion, whether we talk about the ability to separate businesses, or whether we talk about bail-in. In the end, we always talk about an agile institution with a very sound and very agile management information system. And I think I did not hear the industry participants saying that it's not needed. Of course, when you ask about, well, how to separate, my starting point, I think, like the one that was discussed, would always be the recovery plan, and then to think about, am I able to slice and dice the business in any form or shape? And on the MREL discussion, what's important for me also is just to reiterate again, it's good we have the ability to really operationalize the bail-in at the parent level, but we also need to ask the question, what if MREL, internal MREL, is not sufficient or is at the wrong place, because there is in total sufficient MREL, but it's in another entity. So I think there's more work to be done. I don't want to repeat all this, but it's clear that achieving full resolvability, and now I'm using a phrase that a former board member was always using, is a long journey. My wording would be, it's a marathon, not a sprint. And we are coming close to the finishing line. I think the line is coming into sight, as 2023 should be the final year. And I'm now immediately switching to Sebastiano's comments on our 2022 MREL policy, though the one or other might have thought all is changing. No, it's just a continuation of most things that are long known. I think the only thing that's a clarification and potentially a change is the quick fix in this 2020 MREL policy. The rest is continuation. And we are currently contemplating, and that's something to chew on for the moment, that as we are getting into 2023, so hopefully the 2023 policy, not just MREL, but overall, will be the steady state policy to even start another round of industry consultation. So please stay tuned for the second half of this year. There might be coming questions, your side, and the offer for you to give your view on this. With all this, let me allow to come to a close. Thank you once more to all our speakers and to all of you who have attended. May I have a wish? Then I would like to know that we had a long list of questions in the chat, so that next time we can even get your questions even more into the discussion. But I hope anyhow the next time will be a hybrid meeting, so in person, but for those that can't make it to Brussels, also as an online format, and that we keep the good cooperation. And then last but not least, please all stay safe. And at that point, I'm always moving in my German, native German. Bitte bleiben Sie alle gesund. Thank you. And I wish you a very pleasant day and remaining week.